In 60-some years of investing, I've learned that the most dangerous words on Wall Street aren't "this time is different." Though those words have caused plenty of heartbreak. No, the most dangerous words are actually everybody knows. Everybody knows this company is finished. Everybody knows AI is going to eat it alive. Everybody knows the smart money already left. Well, I've made most of my real money in life stepping into rooms that everybody had already decided to leave. And today I want to talk to you about one of those rooms because something rather unusual is happening. Something that, frankly, I don't think gets explained very clearly to regular people who are just trying to take care of their families and their futures. So pull up a chair. Get yourself a cherry Coke if you have one handy. This is going to take a little while, but I promise you, by the time we're done, you'll understand this situation better than most of the people who are actually paid to understand it. The company's called ServiceNow. The ticker symbol is NOW, and before your eyes glaze over, I want you to stay with me because the story here isn't really about software or technology in any complicated sense. It's about something much simpler and much more enduring. It's about a business so deeply woven into the fabric of how large organizations run that ripping it out would be roughly as pleasant as performing your own appendectomy. I've always liked businesses that are genuinely hard to leave, the ones where the switching cost isn't just inconvenient, it's practically unthinkable. ServiceNow is one of those businesses, but the stock has been cut nearly in half over the past year, and Wall Street, in its infinite wisdom, has decided that artificial intelligence is going to destroy it. Now, I've seen Wall Street be wrong about a great many things in my lifetime. I watched them decide that Coca-Cola's best days were behind it in the early 1980s. I watched them fall out of love with American Express after a salad oil scandal. I watched them write off the entire American banking system in 2009. And every single time, the underlying business kept right on doing what good businesses do. It kept serving its customers, kept generating cash, kept compounding quietly while everyone was busy panicking. So when I hear that the market has slashed a high-quality, cash-generating enterprise nearly in half because of a theory, and I want to emphasize the word theory, I pay attention. I pay very close attention. Now, let me tell you what's really caught my eye here, because it isn't just the business fundamentals, though those matter enormously, and we'll get to them. What's caught my eye is who is buying. And I want to be careful here, because I'm not one to read too much into any single data point. And I'm certainly not suggesting that everything people in Washington do is driven by the purest of motives. Charlie Munger, my late partner and the sharpest mind I've ever sat across a desk from, used to say that if you want to understand why someone does something, start by figuring out what's in it for them. Well, let's apply that logic here. We have 6 members of the United States Congress, Republicans and Democrats, which in this environment is roughly as rare as finding a 4-leaf clover in a parking lot, all quietly buying shares of the same company. These aren't random members of Congress. These are people who sit on the subcommittees that directly oversee artificial intelligence regulation, government technology contracts, cybersecurity, defense spending, and the allocation of federal dollars to technology companies. One of them literally chairs the subcommittee on government contracting and infrastructure. Another chairs the appropriations subcommittee and holds the government's checkbook. Another has a verified track record of beating the S&P 500 by over 100 percentage points since 2024. I'm not saying any of them have acted improperly. That would be for others to determine. But I will say that when 6 people with that level of access and that level of accountability to their own track records all converge on the same stock, I think a reasonable person would want to understand why. And then there's the president himself. Donald Trump personally holds over $1 million in ServiceNow stock, and his administration has signed a substantial new contract with the company through the General Services Administration, the agency that handles purchasing for the entire federal government. The deal gives federal agencies a 70% discount on ServiceNow's AI platform. Now, you can think what you like about the politics of all that. I've always tried to stay out of politics, and I intend to keep doing that today. But as an investor, when the President of the United States owns a stock and his administration is signing major deals with that same company, I register that as a data point worth examining. Then the CEO of the company, a fellow named Bill McDermott, went ahead and put $3 million of his own personal money into the stock at these prices and simultaneously canceled his pre-scheduled automatic stock selling plan. 4 other executives followed suit, and the board authorized a $5 billion share buyback. Now, executives sell stock for all kinds of reasons. They need to pay taxes, they want to diversify, maybe they've got a ranch somewhere that needs a new fence. But when a CEO cancels his selling program and starts actively buying with his own money, there's really only one reason for that. He thinks the stock is cheap relative to what he knows about the future of the business. And he used the phrase, once in a generation moment. I've heard a lot of CEOs use a lot of phrases. Most of them are trying to convince you of something. But a man putting $3 million of his own money behind those words tends to lend them a certain credibility. So what does this company actually do? Because I think that's where most people get lost. And honestly, if you can't explain what a company does in plain English, you probably shouldn't own it. Here's the simplest way I know to describe it. Imagine you run a hospital, you've got 10,000 employees, hundreds of departments, and on any given day, you have a nurse who needs a new laptop, a patient whose records need updating, a new doctor who needs to be granted access to various systems, an invoice from a supplier that needs 3 different approvals, and a security alert that got triggered at 2 in the morning. All of those things need to go somewhere. Someone needs to receive them, assign them, track them, follow up on them, and make sure nothing falls through the cracks. In most large organizations, before ServiceNow came along, this was handled by a combination of spreadsheets and emails and phone calls and very stressed out people who spent most of their day chasing other people down hallways. ServiceNow built a platform that handles all of that. It is, as I think of it, the central nervous system of a large enterprise. It connects the brain to the arms and legs. Without it, a big organization is a little bit like a body that hasn't quite figured out how to coordinate yet. Lots of activity, not a lot of efficiency. Now, 85% of the Fortune 500 runs on this platform, 85%. And here's the number that I find even more remarkable than that one. 98% of their customers renew every year. 98% in 40 years of studying businesses. I can count on one hand the companies with customer retention numbers like that. It means that once a large organization builds ServiceNow into how it operates, they essentially never leave. The cost of leaving isn't just financial, it's organizational, it's cultural. It's the kind of disruption that keeps CIOs awake at night. ServiceNow has what I call a moat. And in this case, the moat isn't particularly glamorous. It's just the accumulated weight of 10 years of deeply embedded workflows and integrations, but an unglamorous moat is still a moat. Now, let me address the elephant in the room directly, because I think it's important to be honest about the fear rather than wave it away. Wall Street is coined a term, SaaS apocalypse, which refers to the theory that artificial intelligence is going to make human employees obsolete, and that if companies need fewer employees, they'll need fewer software licenses, and therefore companies like ServiceNow will lose most of their revenue. The theory goes something like this. If AI can do the work of 10 people, maybe you only need 1 person and 1 software license instead of 10. And on the face of it, I'll grant you that sounds logical. The stock market isn't completely irrational. It's pricing in a real risk. I've learned the hard way never to dismiss the market's concerns as foolishness, even when I disagree with the conclusion. The market contains a lot of smart people. Sometimes they get things wrong, but they usually have a reason. The problem with this particular theory, as I see it, is that it treats ServiceNow as a victim of AI, when the evidence suggests it's becoming one of the primary beneficiaries. So here's my analogy for that. When the automobile was invented, a lot of people thought it would be the end of the road building business. After all, horses wore out the roads. Cars would just wear them out faster. And eventually, everyone would have a car and the roads would be done. Well, that's not quite what happened. What happened is that the automobile created an almost insatiable demand for better roads, more roads everywhere. The infrastructure didn't become obsolete, it became more essential. AI, as best I can understand it, is doing something similar to ServiceNow. Artificial intelligence agents are extraordinarily capable, but they don't exist in a vacuum. They need to know which tasks to complete. They need to know who approved what. They need to file their work somewhere. They need to connect to the existing systems of a business. They need, in short, a platform to run on. And ServiceNow is already inside the infrastructure of most of the largest companies in the world. As McDermott himself put it, AI without a workflow platform is like a brain in a jar. Technically impressive, completely useless. That's a pretty good line, actually. I might borrow it. And the numbers are beginning to bear that thesis out. ServiceNow launched an AI product called Now Assist, which is admittedly not the most imaginative name. But then again, Berkshire Hathaway isn't exactly a name that sets the pulse racing. Now Assist went from zero revenue to $750 million in contracted value, and they're targeting $1.5 billion by year end. To put that in perspective, the core business took ServiceNow 20 years to reach comparable revenue milestones. The AI product is moving at a speed that is, frankly, unusual, even by the standards of software companies that tend to grow faster than most. Now, I want to be careful here because contracted value and recognized revenue are not the same thing. And I never want to get too excited about what might happen versus what is actually happening. But the trajectory is meaningful. And more meaningful still is what they've done to their pricing model. ServiceNow is shifting away from charging per employee, which is precisely the metric that Wall Street fears will shrink as AI replaces workers, to a consumption-based model where companies pay based on how much AI work actually gets done on the platform. That is a rather elegant solution to the supposed problem. If AI agents are doing more work than humans used to do, then those AI agents are consuming more of the platform, and ServiceNow gets paid more, not less. More than half of their new contracts are already structured this way. So the company has looked at the same threat Wall Street is panicking about and built a business model that turns it into an engine of growth. That's not an accident. That's a management team that understands what business they're actually in. Now, let me talk about the valuation, because I know that's what a lot of you are waiting for. And I want to do it in plain terms rather than hiding behind jargon. A year ago, ServiceNow was trading at over 100 times its annual earnings. That is an expensive stock. Even I wouldn't buy a company at 100 times earnings. There aren't many businesses in history worth that multiple. And frankly, the ones that tend to be the exceptions, not the rule. But the stock has fallen so sharply that today it trades at about 60 times current earnings. And if you look at what earnings are projected to be a year from now, and I want to emphasize these are projections, and projections have a long and undistinguished history of being wrong. The forward price to earnings ratio drops to somewhere around 15. That is Microsoft territory. That is the multiple you'd pay for a company that is growing slowly and predictably, not one that is growing revenue at 22% annually and has a new AI product that is scaling faster than almost anything else in the enterprise software space. Now, I've always said I'd rather buy a wonderful business at a fair price than a fair business at a wonderful price. By that standard, a wonderful business at what looks like a reasonably fair price has a certain appeal. I can't tell you the stock won't go lower. I've been wrong about timing more times than I care to admit publicly, and I've learned to be extremely humble about the short term. The market can stay irrational longer than any of us can stay patient. But if you're asking whether the business is fundamentally impaired or whether the stock is pricing in a catastrophe that hasn't actually materialized in the underlying financials, my honest read is that it's the latter. Let me tell you what I genuinely don't know, because I think this is just as important as what I do know, and I'm suspicious of anyone who leaves this part out. I don't know with certainty how quickly AI adoption will change the demand for software licenses across the enterprise sector. The transition from per seat to consumption-based pricing could be lumpy and painful in the near term, even if it works out beautifully over the long term. And near-term pain tends to be what sends stocks lower, not the long-term story. I don't know whether the government deal will generate the kind of revenue growth the company is projecting, or whether Washington's interest in ServiceNow's platform will outlast the current administration's particular enthusiasm for it. Government contracts are wonderful, until they aren't. And I've seen a great many businesses that got comfortable with government revenue find themselves in an uncomfortable position when the political winds shifted. I don't know whether ServiceNow's competitors, Microsoft, Salesforce, and a half dozen others with large ambitions and large balance sheets, will find a way to erode the company's competitive position over the next several years. And I don't know whether the current valuation already reflects some of the good news, such that even if everything goes right, the stock doesn't move as dramatically as one might hope. These are real risks. They deserve serious consideration, not a wave of the hand. Truly uncommon. I've spent 60 years looking for businesses with durable competitive advantages, and the ones that have them tend to share a few characteristics. They're hard to displace. Once they're embedded, their customers don't leave because leaving is costly. They generate significant cash that compounds over time, and they're run by people who think like owners. ServiceNow, from what I can see, checks those boxes. There's a certain irony in the current situation that I want to point out, because I think it illuminates something true about how markets actually work. The very thing that Wall Street is treating as an existential threat, artificial intelligence, is the thing that ServiceNow is using to accelerate its growth. The fear is based on a linear extrapolation. AI reduces headcount. Headcount reduction reduces software licenses, and therefore ServiceNow shrinks. But businesses and technologies rarely evolve in straight lines. The automobile didn't make road builders obsolete. The spreadsheet didn't eliminate accountants. The internet didn't eliminate the postal service, though it put a significant dent in their stamp business. I'll grant you that. The history of technology is full of examples where the arrival of a powerful new tool didn't eliminate the platforms it ran on. It made them more valuable. Whether that's precisely what happens here, I genuinely can't say with certainty. But the hypothesis is logical. The early data is consistent with it. And the people with the best access to what's actually happening inside large enterprises and government agencies are voting with their wallets. Now, I want to say something about how to think about an opportunity like this, because I think the framing matters as much as the analysis. And I've made my best investments not by trying to be clever, but by trying to be patient. The companies that have created the most value in Mercer's portfolio weren't ones I bought because I thought they were going to have a great quarter. They were ones I bought because I understood what they did. I believed in the durability of what they did, and I was willing to sit quietly while the market figured out what I'd already figured out. Now, ServiceNow isn't the same as Coca-Cola. It doesn't have the same 100-year track record. And the technology landscape it operates in moves faster and with less predictability than the beverage industry. I'd be misleading you if I pretended otherwise. But the underlying question is the same question I've always asked. 10 years from now, will large organizations still need a platform to orchestrate all the complex workflows that keep them running? Will the 98% retention rate hold because the cost of leaving is genuinely prohibitive? Will the AI tailwind turn out to be a headwind or an engine? Those are the questions we're sitting with. The stock price, the congressional buying activity, the CEO's personal bet, those are clues, not conclusions. The conclusion has to come from your own honest assessment of the business. I've watched a lot of investors make a lot of money over the years, and I've also watched a lot of them make the same mistake over and over. They fall in love with a story, they get excited about the narrative, the politician buying, the CEO betting big, the government deal, the AI thesis, and they forget to keep asking whether the story is true. Because a compelling story and a good investment are not always the same thing. And separating the two requires a certain cold-eyed discipline that doesn't come naturally to most people, myself included, on my worst days. So I'd encourage you to do something that I've always tried to do: strip away the narrative, ignore the politicians for a moment. I'm not telling you to buy this stock. I never tell anyone to buy any particular stock because I don't know your situation, your time horizon, your tolerance for watching something go down before it goes up, or the 20 other things you're juggling in your financial life. What I'm telling you is that the fear driving this stock down is based on a theory about how AI will affect software demand, and that theory runs counter to what the company's early AI numbers are actually showing. Theories lose to data eventually. They always do. Sometimes it takes longer than you'd like, and the journey from theory to data can be uncomfortable to hold through. But in my experience, the businesses that are genuinely better than the market believes tend to prove it quarter by quarter in ways that are hard to argue with. And the investors who do best are the ones who were there before that proof became obvious to everyone. Charlie once told me that the key to wisdom isn't knowing more than other people. It's knowing what you don't know. I think about that a lot when I look at situations like this one. There are things I genuinely don't know about ServiceNow's future, but there are things I do know about durable businesses and how the market tends to undervalue them when fear takes over. And on the balance of what I know and what I don't, this strikes me as exactly the kind of situation worth keeping very close to. The world is full of opportunities that look obvious in hindsight. The ones that matter are the ones you have the courage and the patience to understand before the hindsight arrives